Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and this is the earnings special conversation where we're going to be having Persistent Systems with us to explain to us and decode for us what the earnings have been like, and of course, what's the vision going forward from here. Let me welcome our very special guest joining in. Sandeep Kalra joins in, the Executive Director and the CEO of Persistent Systems. Warm welcome to you, Sandeep, and thank you so much for taking the time out. Another strong quarter. So, congratulations right at the outset. In fact, you've delivered 23rd straight consecutive quarter of revenue growth that we have seen, especially in an environment that we've been seeing consistent slowdown. Spending is very selective at this point in time. What is that one factor that has consistently helped you defy the slowdown in this period, sir?
So first of all, it's good to be here. Thank you for having me on the channel. Just to summarize the results, we delivered, as you rightly said, the 23rd sequential quarter of growth. We had 4% quarter-on-quarter growth in dollar terms and 17.3% on year-on-year basis, delivering $422.5 million. Not only did we deliver a good growth in revenue terms, we also had a decent profitability growth, barring the one-time new labor code impact, which has impacted everyone in the industry. For us, the impact for this new labor code came in at about 2.3% on EBIT margin and 1.8% on PAT margin. At an operational level, the EBIT margin outside of this impact came in at about 16.7%, which is a quarter-on-quarter improvement for us, and pretty reasonably happy with that. On the PAT level, we came in at 13.4% outside of this impact, and including this impact, we came at 11.6%. Now, to your point, what is holding us in good stead is two, three things. Macro being macro, we don't control that. What we control is how do we react to it? How do we invest in latest technologies like AI? How do we get closer to our customers, understand their business imperatives, help them use AI or other technologies to solve for their business goals? If you look at our order book, this quarter, we had more than $500 million in ACV terms, annual contract value terms, the revenue recognizable over the next 12 months. And we have been doing well on order book for the last several quarters. Now, these bookings translating into revenue is what held us in good stead. The other side, I will say, is on AI side, we have been working with our customers for last several quarters doing proof of concepts. Some of them are now reaching bigger level and getting to fruition on bigger projects. So that's where it is.
Absolutely. Do help us understand, the new labor codes and the impact has been the big talking point for the entire sector. This time around, what we are given to understand is that 2.3% hit on EBIT as well as a 1.8% hit on PAT is what we have seen this quarter. So are we done with the impact? Will there be any residual impact in Q4? And in FY27 also is something that investors would want to learn from you.
Sure. So Sakshi, if we look at it from our perspective, and the way we have provision for this is a catch up based on the regulation announced by the government. So this is a one-time catch up, and now it will be in the operational cost, and we do not expect any other hit in the next quarter or the next year unless something new comes in the labor code. And if it comes, it will be for the entire industry, for our India-based team.
Also, can you help us understand when do we see normalization kick in for the EBIT margins? Are we at the low point? Are we already at the improving point? From here, where do we go? What's the kind of lens that you can share with us as to how do we see the margin normalization from here?
Yeah. So it's actually, if you follow our company for the last 5-6 years, we've come from sub 10% EBIT to 16.7%. I don't think our aspiration is to take it too far out. We had said we'll improve EBIT over a period of time. We've delivered that. Our thing would be to be in the range of 16 to 17%. That's our aspiration. Things may go one quarter or the other, lower, higher, whatever it is. But on annual basis, we want to be in the 16 to 17% EBIT range. And then whatever is there, if we are able to do better, we have to reinvest in our business. The reason we grow today, if you look at it, we are growing at 17.3% year-on-year basis, which is possibly among the highest in our sector. We need to make sure that our investment in our capability, the reason for which our customers engage with us, remains intact. So margins between 16 and 17, rest in investment, capability build, and growth.
Fantastic. Let's talk about order bookings. This time around, a $674 million TCV and a $500 million ACV, quite robust on both the accounts. How much of this is truly coming in from the large multi-year transformation deals versus if we talk about maybe smaller tactical wins?
Yeah. So if you look at it, 2-3 dynamics in this quarter. Our biggest geography is the US. US financial year end is December. So our October, November, December is usually the bigger quarter for us, both for renewals and combination of new deals. So if you look at it, healthy mix, and all of these are public disclosures. So from that perspective, fairly good mix of new business and the earlier wins, and we expect this to continue in the times to come. So booking wise, pretty confident of the trajectory, and some of these are larger deals. The TCV to ACV, if you look at it, it's been a healthy, in the range of 1.3 plus minus for last several quarters.
Right. So, if you could also tell us what is the conversion cycle for these deals into revenues, and what is the timeline for that?
Yeah. So Sakshi, there are two metrics that we announce. When we talk of annual contract value, we are talking of realizable revenue over last next 12 months. When we
Hmm.
talk of total contract value, that is the realizable value after 12 months. So all of these are there in our disclosures. So when we say for $500 million plus in ACV, that's the revenue that we expect to come out of these contracts in the next 12 months. And you can extrapolate for each of the quarters.
Okay. Let's also talk AI and how much of the current order book is largely AI led or AI enhanced, if I can ask, or when does it truly become a standalone growth factor for you that you can call out in the revenue aspect as well?
So Sakshi, our view is everything that we do is going to get impacted with AI. AI is going to be a part of that, and it's going to become table stakes. It's not that this is AI and this is non AI. So I don't think as a company we are of the view that we should be declaring AI revenues, because a few quarters from now, everything, whether it has small component of AI or big component of AI, will be there. It's like anyone who has followed our industry.
Hmm.
Earlier, people used to talk of digital, then everyone said everything is digital. So I think AI will be far more pervasive and much more into everything that we do. So down the line, I don't think this will be a discussion as well.
Okay. When we talk about AI specific hirings, how has it really changed over the last couple of quarters for you? And going forward, what's the thought process there?
Yeah. So there are two sides to this equation. So when we say AI specific hirings, we don't get talent out of schools and normally in the industry, which is like been doing AI, or still AI may be there, but generative AI
Hmm.
for many years, because generative AI is a recent phenomena, and this is a very fast evolving phenomena. The way
Hmm.
we were looking at generative AI even 2 years back, 1 year back, 6 months back versus what it is now and what it will be are two different things. So what we are looking at is in the US and otherwise a handful of people where they are coming from the industry which is developing this technology, and then marrying them with the horizontal technologies related people that we train. So we have a significant amount of investment in training our people, and also bringing people who are coming from outside who have more jobs along with the capabilities that we have in our company.
Okay. When we also talk about deal cycles, are you seeing any shortening on the deal cycles or the, kind of, especially the BFSI high tech led verticals? What exactly is the macro uncertainty impact there on the deal cycles and the discretionary spend?
Yeah. So look, I think by now everyone is getting used to the fact that it will be a noisy macro going ahead. I don't think anybody can expect that these things will stabilize and so on and so forth. Yeah, there will be midterm elections. There'll be maybe some things that may slow down in terms of the rhetoric, etc., and then it may pick up. So all of us have to get used to working in this, whether it's our customers, ourselves. And so the bigger thing is understanding where our customers are going, where their investments are going. And we have seen an uptick in our healthcare, for example, sector in terms of demand. Some of the programs are transformational programs, which you may call discretionary, that are coming back. Overall, from our perspective, we are just focused on our top 100 customers, going deeper on one side, investing in technology, marrying these two, making sure that we execute impeccably and deliver growth and returns to our investors.
Which verticals will continue to be key growth drivers for you in FY27, Sandeep?
Yeah, so as of this point in time, the way we look at it, BFSI is leading the growth as of this point in time for the near next few quarters. Healthcare had gone down to single digit growth. It is also coming back year on year, and high tech continues to be somewhere in the middle. So it'll be a secular growth, and we'll let the things pan out. But this is the pecking order that we see as of today.
Sandeep, you've been also vocal about your $5 billion revenue growth goal. Could you tell us, with the current growth rates that you are expecting for yourself, the agentic AI push also, what is the realistic timeline that we can expect for this?
Yeah. So first of all, it's not a guideline that we are saying or a guidance we are saying. We are basically saying aspiration. So our aspiration first is $2 billion by run rate by March 27. We are on that journey. And if we continue our growth rates, that's our aspiration to deliver that first. That lays the foundation for the next. And we've always said, whether it is 27, FY27, $2 billion run rate, or FY31, $5 billion run rate, there'll be a small amount of acquisitions related revenue, the inorganic revenue that will also be there. So far, the team has impeccably executed. We have the blueprint. We are on it.
All right. All the very best to you, Sandeep. And thank you so much, as always, for taking the time out for our viewers, explaining to them what's the thought process for the company, what is the trajectory that they are taking at this point in time. I wish you all the very best for the upcoming quarters as well, and hope to see you soon.
Pleasure talking to you.